So on this course, we're going to be exploring how to find the right investors. Now this is an area that probably nearly every entrepreneur gets stuck on. How on earth do I go about finding the investors for me? Where do I even start actually looking for them? How do I approach them? How do I actually get them engaged? And how do I start negotiating with them? It can seem a bit kind of mystical. Then often entrepreneurs go online and they start Googling it and trying to work out how to do it that way, and then there's obviously a dozen different ways of doing it, so they get ultimately confused. Now, I've evolved this system over a long period of time, and I know it works because I've coached hundreds of entrepreneurs through this actual system to raise many millions of pounds through it too. It's not invaluable, but it does actually it does work if you follow the system. Now the key is that it's called how to find the right investors. So not any old investor will do. How to find the right investor for your particular business is absolutely key, because as soon as you start generalizing everything and trying going out for generalized angel investor events, then you're going to spend a very long time looking for money, looking for capital, that is. So you want to focus on investors that actually understand your sector, understand what you're about your business. You don't have to educate them, they'll get it really quickly. They won't feel scared about investing in something of your nature because they'll understand it already, they're in the zone. They can also help people that you can connect with and add even more value that way. They can add advice to what you're doing, and because they're often savvy investors, they might have deep pockets that they can then fund the future round. So again, I'm not looking for you to just find any investors just to muddle your way through. I want you to find the right investors that's going to follow you all the way through your life cycle of your business, which ultimately, hopefully, will actually end in selling the company at some point, maybe 5-7 years time. This is the basis of how to find the right investors. Now, there's several different types of investors that we're going to be going through. One of which is angel investors that a lot of entrepreneurs have heard about, and these are basically high net worth individuals that are looking for investment opportunities, often categorized as very high risk, to invest their own money in. Then you've got more kind of institutional investors like smaller VCs or larger VCs, venture capital firms that use other people's money to invest into propositions. And then you've got the new kid on the block, which is basically equity crowdfunding. Now, not reward funding, not reward sites, but equity crowdfunding. If you're in the UK, it is Crowdcube and it's Seedrs primarily. There are others, but those are the main ones. So there's a whole mix there of 3 different types of investors. There are more, but those probably cover about at least 80% of investors. And this is what we're going to be exploring in the next section. Okay, firstly, we are going to be talking about angel investors. I would say that most of the entrepreneurs that I speak to nowadays have had at least one angel investors, more often not a group of them, and sometimes even as many as 20 or 30 angel investors into one investment round. So let me talk a little bit about what are the expectations of angel investors first, and then we'll go through a kind of step-by-step of how to actually find them, and then how to maybe start engaging with them. The basic mindset is that often angel investors, they are about, I would say probably at least 80% or so are ex-entrepreneurs that have actually sold a business at some point, maybe their own business, maybe they co-founded another company, or they've been involved in another company early on, and now they've got some lump sum of money, and they put some of their money into property, some of it into stocks and bonds. So, safer bets basically. And then they they want some money, maybe 10% or to 20% of their money to go into what they regard as high kind of risk asset class, in other words, angel investing. So they would like to make a return on their investment, obviously, but a lot of them don't. A lot of them actually fail. In fact, only about a third of all angel investors actually do make any money out of it at all. The rest are basically better off putting it under a mattress. But what you're looking for is more kind of smarter investors, the ones that do understand how to play the game of angel investing and do understand that to be the best investor, they've got to really add value to the proposition, not just the cash. So they've got to add the cash plus their own experience and connections, and hopefully you'll have good chemistry between the two of you, and that mix, it really is, will really accelerate your business. So a really good smart investor is what you're looking for. So an angel investor would typically put in somewhere between £10,000 and maybe all the way up to £100,000. On average, I would say a typical angel investor might put in somewhere between £20,000 and £50,000. The super angels, or the angels that put much more money to invest in, they will maybe put down the £100,000 mark, and maybe even more than that, if they really understand the sector. So, for example, if you've got a round of, say, £250,000 that you're looking to complete, it might take as many as 10 investors to actually complete that round. So you're probably going to have to try a number of different avenues, which we're going to go through. Now, a key motivation for investors is, firstly, they really got to get on with the founders. They've got to like the founders, really kind of trust them, believe in them, and they've got to like the idea. They've got to be excited about the idea, the impact in the world around them. And they want to be proud of the fact that they're telling other people that are invested in this idea. But obviously they're not doing it just as a charity. They're actually doing it because they want to make a return. So they are looking for a 10 times money back return. Now, it might seem like maybe they are a bit greedy after all, but actually 10 times money back is a reason for that. And firstly is because if an angel investor had a portfolio of 10 companies, and typically 3 or 4 of them will die quite quick. It'll just go out like a light, maybe within the first year, maybe 2 years. And then there'll be another 3 or 4 that the investors sometimes call zombie companies. They're just like the Walking Dead companies, sucking the life force of not only the investors' money, but the founders' own life force along with it, and it will never get an exit. It just barely makes a profit, if a profit at all. And it will never get an exit or anything, but it will still be there. A lot of the investors would be happy just to shoot that one dead, but they just hang around, and sapping the life force out on the investors. And the investors are very wary of these companies, and they really don't want you to be the next zombie company. But the fact of it is, so an investor will have a bunch of companies that will die. Some will still just hang around, not doing a lot, and then there will be 1 or 2 that will really go well and really get a good return on investment for them, and actually manage the company get sold at some point. The average is actually 7 years after launch that it will get sold, but they're always aiming for a 5-year timeline. So so imagine that if they only aim for like 2 times the money back, then they're going to lose money every time. Even 5 times money back, they're going to lose money every time. The only way they've got to stand a chance of playing the game to win is to invest in 10 deals that have high growth opportunities, that have a chance of 10x return, and then one of them, at least 1 or 2 of them, play out and actually does return their money, and then their portfolio might actually be in a gain situation, rather than actually lose money like the rest of them. So that's the reason why they're looking for, on average, a 10x return. They want that if you do manage to go all the distance, that the opportunity will be a big opportunity for everyone. So that's the mindset of an angel investor. So where do we actually find these guys? Well, firstly, the obvious choice is angel networks. So there are a whole bunch of them in almost every country that I've been to. There's angel networks, which is band of angels that clump together, and then they assign someone as the gatekeeper to filter all the deals that are coming through that network. There are 2 types of angel groups. There are ones that are curated by the angel investor themselves, in which case the fees are going to be pretty low to nothing, and they are going to be in the region of, at the most, around about kind of £300, 300 sterling pounds, and but anything beyond that would be probably more of a kind of a angel network run by entrepreneurs or other professionals, and the main way they get their income is through the upfront fees and through success fees. The success fee is typically 5% of money raised. So if they manage to raise for you £100,000, then you would give them £5,000 as in fees. And not only that, but you'd pay them an upfront fee as well. Typically, it can go in excess of £2,000. Not unusual for it to be £1,000 to get a chance to pitch. Now, I wouldn't generally encourage you to use those kind of networks. There are some really good ones that do charge, but they are very few and far between and don't get fantastic results. Now, the reason being is that if you get an angel network that charges, say, and I have known it, £5,000 to actually pitch, then the main metric for them as way of filtering deals is how much can you pay as an upfront fee, and then you're in. Whereas you don't want that, because the angel investors that go in to turn up on the day to watch the pitches, they want to be assured that all the deals are well filtered, and actually only the credible deals that have come in that month are the ones they get to see. Now, if you go to an angel network that is not very well supported by the angels, then what's going to happen is that the deals that they see are actually what they regard as low quality, and then they will never go again. But the only people then do show up will actually more likely be advisors or other kind of people that just want to go along and watch other people pitch. So I'm just flagging that as something to watch out for. Now, if you're in any doubt of whether or not an angel network is any good, then just ask them a single question, and that is, how many deals have you actually funded through your network in the same sector as mine within the last year? And if they can't give you any names, or they say it's top secret, then just move on to another network. There are a bunch of other credible networks, and in the actual course I have given you a downloadable file that is a pretty active group of angel networks that I have personally checked over and I know about, and offer a very good chance of success should you pass through their filtering process. Now, the filtering process would normally look like they'd ask you for that one-page exec summary. They would sense check it. They might get on a phone with you. They might do a Skype call with you, or they might meet with you face-to-face for about an hour. Then they check through that you know what you're talking about, that you would come across well in your presentation, that your presentation deck and everything is good enough quality for them. And then should you be selected, I would say they'd probably more likely get maybe 30 or 40 applications a month, and out of those they might select about 6. That's not to say it's not worthwhile you doing these and going and applying for them, because a lot of them are actually just not going to be any good at all. I shouldn't even be there in the first place. So, but if you have gone through, especially if you've gone through this course and you've got a really good exec summary, you've got a really good pitch deck, and your financial model makes sense, and you've really got a good proposition, then you stand as good a chance as anyone else, especially if you've got some traction behind what you've done and you validated certain points in your business plan. So it's a very valid option for you. So have a look at the My Curated list, and then start applying using the one-page exec summary. Or some of them have got online forms. So you go onto their website, you fill out that form, or some other instructions that they'll give you, and then just go through the process. Like I said, some of them professionally managed by people other than angel investors, and so on those I charge you 5%, and then I wouldn't pay more than £300, maybe £500 at the most as an upfront fee. And then there are others that are run by angel groups, and at that sometimes you won't even pay, well, you won't pay anything. Sometimes the best groups actually for free, but the filtering process is a little bit more intense, but that's a good thing. So on those groups, they will go through the same process. They'll look at your exec summary or your pitch deck, they'll meet or talk to you on the phone, and then they'll give you pitch practice and training before you actually get your typically between 5 and 10 minutes in front of a room full of investors. In a room full of investors, there will typically be a room between about 20 or 30 investors. Sometimes they're more, sometimes a little bit less. But the important thing is that the people in the room are actually investors. There's lots of angel investment groups out there, but a lot of them are not completely valid. Some of them are just meetup groups. But you don't want to waste your time with that. You just want to get with proper, credible angel groups. So that's that category. You can go down the angel route, and then you can do what I call the DIY approach. So you can then curate your own list of private angels. I would focus on getting about 50 angels and researching them, put them on a spreadsheet, and then treat them like a prospect list. So the key with that though is to really do proper research behind each one of them. So what you're trying to do again is you're trying to find the right investors. You're not just finding any old investor, you're trying to find investors that understand your sector, have invested in your sector in the past, and then have connections with everyone in the sector, and then they will get it. So just for example, only recently, before I recorded this video for you, I had this coaching client that had this gaming company, which is traditionally not that easy to actually, as a proposition, to sell into the UK, mainly because it doesn't fit with some of the tax regulations. So the investor kind of loses a lot of the tax regulations straight away. And also there's not that many angel investors that understand that sector. But so they tried a few groups, they tried a few angel groups and tried a few other independent groups and tried randomly sending the deal out to people. But in the end, they curated their own short list of 20 angels that actually understood the gaming arena, actually even working in it or had companies themselves in that kind of arena. And then he approached them and I'll give you the approach in a minute, but he'll approach them, and then by the end of the week, they had someone seriously interested. And I think they only got as far as 5 people that they started approaching. And they had one guy that invested the entire amount because he understood the sector so well. He could see there was a way of leveraging what he was doing, what they were doing, but he gave them carte blanche and the entire amount, the valuation they wanted, and everyone was happy. Now, it would have taken much longer if they hadn't been so focused, hadn't done the research behind it. So it really is worth taking the time out. You go onto LinkedIn or you go onto another site called AngelList. AngelList lists all the angel investors, typically a lot of angel investors in America, but there's also well over 2,000 angel investors that are based around even just the London area alone, actually on that site. Now, I wouldn't recommend that you put a pitch up on the site, but only use it for a research tool. So you go up and you key in, you will look up the London investors, but then what you're doing is you're looking for the sector, the same sector that they've invested in the past. Because on that site, you can see all the deals they've invested in the past. And then you can curate your own list using that and LinkedIn. And then you maybe see if they've got a blog, have a look at their Twitter account, have a look at any other social media that they've got, and any conferences they've been to in the past, see who they're connected to, and draw up a kind of like a real kind of profiling, almost like Sherlock them, so you really do understand a lot more about their makeup and what actually drives them, what do they wake up thinking about, what are their major projects at the moment. And then you can work out how to connect your world with their world. Essentially, that's what you're doing. If you don't do that approach, then you just come across as a spammer. So you need to actually curate this list of, say, 50, ideally 50, because on average it'll take 50 approaches to get one really top-end anchor investor or lead investor. Often it takes much less than that. Like I said on the gaming example, it took 5 contacts to get the absolutely perfect ideal investor for them. So you go work your way through the list. I would recommend doing, say, maybe 2 of these a day. And you're going to have to create some of the messaging yourself. But if you can also download my template on how to actually reach the investor, what kind of messaging to put in like an approach. And it is a soft approach. It's not like you're trying to sell, stocks and bonds or anything, or it's not a hard sell approach. Because approaching an angel investor is almost like being a horse whisperer. You have to kind of let them come to you. You can't run at them, because they believe me, they'll run away, and you will obviously come across a little bit on the desperate side. So the key is once you've curated the list, and then you reach out using that message that you can download. It's how to approach an angel investor on LinkedIn. Download that. You can obviously adjust the template to suit that particular investor. So you're trying to assess what is the criteria that matches what they're interested in to what you're interested in. So you talk mainly about them for the first part of the message, not about you. And the subject line is about them as well. Something in their world that they're interested in. It could be a past deal they've made. It could be a conference they've attended. It could be a blog post that they've made, they just recently published. So something about them in the subject line. Then they open the message and they see it's still about them. You've made the connection. You've noticed that they're in the same sector as you and you've been impressed by what they've done in the past. They know that the experience that you have could add massive value to what you've got. And then you think that maybe there's a good fit here. Would it be something that they would be interested in as an investment? If it is, then you lean into getting them to reach out for the one-page exec summary as an offer. If they are interested in that, then they've just put their hand up to say, you know what, I'm interested, and let's have a conversation over this. So that's what the main point of the first contact point is, to try and get them to make the first move towards you and then start that conversation. The first move is asking for that one-page exec summary. And if you haven't seen the course already, go to how to create a compelling one-page exec summary on this video course series. Now you've got their attention and now you've got a dialogue. You've got their, now once they've got the one-page exec summary, now you try and get them to do face-to-face dialogue. Some of them work by Skype, and if you've done your research, you'll find out some of them like doing Skype, some like doing telephone, and a whole bunch of them like doing face-to-face meetings. So you're trying to set up a meeting with them, make it super convenient, and then you meet with them to do your pitch and present your pitch deck in under 10 minutes, and then get to Q&A, and then it gets into negotiation period. Now, what you do want to do is have a whole bunch of these investors, have as many investor meetings of the right investor as possible. You always want to have a feeling of increase, a feeling that you will not going to run out of investors. So that means approaching, say, 2 investors every day using this process, work through your list of 50, and then hopefully you'll get, ideally a half a dozen investor meetings, of which a few will work out into being a good, smart leading investors. Sometimes all you need is one good lead investor, and they can corral a whole bunch of other investors because they're so credible. People will just follow them just on the basis alone that they've invested in. Now, just for example, I had someone that I was talking to. I was on a panel, and they had a proposition where they needed a really big lead investor because the round was about £1 million, £1 million investment round, which is a lot for angel investors. That's a lot of angel investors. So they needed a really credible angel investor. So they spent half a day researching this ideal angel investor. Now the business is called Y-Plan, and the angel investor was the founder of lastminute.com. So it's another similar kind of ticketing company. And because they spent so long researching this half a day, this investor, they knew exactly how this investor worked and exactly what projects he had in the past. And the investor ended up being their lead investor. And from that, they managed to raise the £1 million round relatively quickly on the basis of that. That's the other way that you can raise or get the attention of and start having a dialogue with angel investors. There's 2. I'll do a recap on the 2. So there is the angel groups, and by the way, I recommend you download that group, my recommended groups, and start applying as soon as you've got a good, credible one-page exec summary, and maybe even a pitch deck as well to go with it. And at least you've got 80% on the actual financial model. So it doesn't have to be pin perfect, but good enough to come up with a credible model. And then you will approach these angel networks, say 2 or 3 of them, and then hopefully start that process off, because that can take sometimes 1 month or 2 months, depending on how often they meet up. In the meantime, you then create your own list and you work through your list doing 2 a day until finally you've got to a situation where you start and develop lots and lots of angel meetings. And so on the next section, I'm going to be talking about how to actually attract venture capital firms. So in the last section, I talked about how to find the right angel investors. This one is going to be talking about the venture capital firms. Now, the venture capital firms are often quite different from angel investors, and that is that they actually do not invest their own money, they invest other people's money. So there often is much more of a pressure there to make a continuing return on investment, and often it's much more of a pressure to get a faster trade sale as well. So there are 2 main types of venture capital firms that I'm going to go through. One is the one that often gets the most publicity is the big VC firms, big venture capital firms that get the multi-million pound exits or even billion-pound exits, and they invest sums of say 5 million, 10 million, or even more in various rounds. But for most of people watching this video, those guys would not be a good fit. Let me explain why. So these guys often have they come from a different motivation, because ultimately they promise to investors they're going to make on average between say 20 and 30% return on investment every single year on average over the course of a fund. They'll have a fund for about 10 years, and then they've got to get in and out of the companies they're investing in within that time period. So imagine if you join the fund like in year 6, they kind of got to sell you in the next 4 years, and no matter what it takes, they'll try and do that. And to be able to do that, they've got to have a lot of control over your company. So they will not necessarily be so fixated on the valuation. They don't even care that much about the valuation, because most of the game for them is rigged towards the end of the game. It's towards the exit of the game. They can easily actually only hold 10% of the company and yet still manage to get like well over half of the proceeds from an exit by lots of back-end terms and clauses in the actual shareholders agreement. In essence, if you are to go for venture capital firms, you will probably be not in the driving seat of that particular of your enterprise. If you liken it to like being on a bullet train, you will probably get to station like maybe super fast. It'll be one heck of a journey. And maybe you'll get into station, or maybe you'll derail horrifically, but you will not be in the driving seat essentially of that train. You might, in 50% of cases, you'll actually be fired from your own company, or maybe even sidelined to a different role, because they will have that understanding with you that if you're going to grow this company, you might not be the person that's going to be the one to actually take it the whole distance, and you've got to prepare to step aside. If that's not going to be the case. If you don't deliver on the plan, you'll have to be prepared to step aside. So this would not suit a lot of people, a lot of entrepreneurs actually raising capital. In some cases though, when you need a lot of capital and you've got a very disruptive technology, you will need a lot of money. And in some cases, you will need venture capital firms. So there is a way of playing one against each other, but still you have to be extremely careful how to do it. So firstly, venture capital, how to find any venture capital firms, if you go to the BVCA, British Venture Capital Association, if you're looking for a kind of UK-based venture capital firm. There are other European counterparts, and a lot of these venture capital firms are listed. You find them on Google searches and all kinds of directories. That's not the difficult bit. You can also find out who the partners of these firms are. You can find out what deals they've actually invested in the past. Again, that's not particularly the difficult bit. You can have endless meetings with them, but it'll often be with the associates, not the partners. And you'll think you're getting somewhere, but often you're not getting anywhere. So what you need to do with them, you basically have to get into a situation they're actually interested in you. And to do that, you have to have a market size that is at least in the £1 billion mark. You have to have or demonstrate serious traction that you can grow a fast moving company. That is, you might have a month-on-month increase in sales or subscriptions or whatever you're doing of about 20 and 30%. It's like really going rapid growth, and now you need their help to accelerate it even further. You would also have on board, if it's a technology company, you would have an in-house CTO, Chief Technology Officer. You'd have an in-house CMO, Chief Marketing Officer, and maybe even a COO, Chief Operating Officer, and then it'll be yourself or one of the other founders in one of the other roles. Typically, they don't like single founders, not always, but more often not, they like co-founders. I think they feel it's kind of safety in numbers, but it's one just to kind of bear in mind if you're actually approaching the VCs. And also, they really want you to validate the marketplace. They want to have that you understand the market fit, that you've actually done lots of validation research, and you've got customers already active and live that you can continually have update and have a dialogue with, so you're continually evolving this project. They don't want you to be just an also-ran player as well. They want you to be one of the leading players in any market that you move into, and also they want you to be laser focused on some kind of exit in time. They're not so laser focused on profit. They're mainly interested in buzz and trying to get an exit as fast as possible. So it's all about building value within the shares that they've got. That's the basic understanding. So if you now understand what they're looking for, you can say that maybe it's not the kind of the right investor for you. Or maybe if you've got a big disruptive technology, maybe it is. But the way to go about it is to actually find the right kind of VC for you by looking at these directories and doing a short list of, say, maybe 10, maybe 12 of them, and then start reaching out to them and try and actually connect, find someone that knows the partners within the firms. Find someone that knows the people that sit around the table deciding which deals are going to move forward and which aren't. And then when you have hopefully attracted attention and got a pitch slot with them, I can spend an hour with them, then they're either going to do two things. They're going to make you an offer pretty quick, like within the week or within 2 weeks, or you will never hear from them again. So you'll have a short window there to impress them. But when you do have one of them involved, then the important thing is to get another VC involved. If you only got one on the negotiating table, there's a good chance you're not going to get a good deal for yourself. So I would highly recommend that you would then immediately go out and try and get one or two more venture capital firms and play on the psychology of venture capital firms, which is called FOMO, fear of missing out. You don't want you want one of the other firms to feel they're missing out on one of the deals of the century and coming to the table, making a counter offer of the offer that you've got. So you're trying to build up a little bit of a feeding frenzy around what you're doing with other venture capital firms. That's probably the best chance you stand of getting a really good deal. The other way is to get a very, very savvy investment lawyer. Someone that really understands all of the terms and conditions that fall into the venture capital kind of game plan. And so get someone that can really educate you about what actually you're getting into, and then flesh out about the best deal that you can get for yourselves in this area. So that's the big venture capital firms. Then you've got the smaller ones. The smaller ones are a little bit more kind of like a little bit kind of user-friendly and cuddly, in that they are often not big funds. Sometimes they're money that's been pulled together by a band of angels, or maybe small institutions, or maybe it's a mixture of both. But typically they're looking, instead of looking for £1 million investments, they're looking for more like £250,000 as a single investment, or even sometimes as low as £50,000 as a single investment, and maybe go up to about £500,000 or £1 million at most. There's quite a few of these. So I have also included in the course a downloadable document of kind of a curated list of these investment groups that offer fair terms. They're interested in nurturing and growing the company, and if you get a chance to pitch with them, you'll stand at least a good chance or a good hearing and get good feedback. And they are some of the most active in this space at this particular time. So the list may change over time, but I'm going to try and adapt to change the list, so you've got a fairly current list. Of these angels, it's very similar to the angel investor kind of approach, that you curate a list of, say, 6 maybe of these funds, no more than 6, but ideally maybe focus on 3, and then you approach the 3 using the one-pager, or you go on their website and find out how they prefer to receive what they call deal flow. Sometimes it'll be an online form, other times it'll be a pitch deck, sometimes it'll be a one-pager. Then you give them what they want, and then usually they have a weekly meeting, and then they decide which ones are going to go forward and which ones are not. So if you haven't heard from them within a few weeks, there's a very good chance that you haven't passed the test, basically, which is not a big problem, because remember, you're trying to find the right investors. A lot of these groups, it might be that they haven't moved forward because there's no one within the group that understands your sector. That has happened to me no end amount of times. I had one lady that had a really good travel company. She had a lot of traction, she had a good team, had all the right things in place, And the investors actually loved it. All the groups you sent it to actually really liked the deal, but none of them could put it forward because none of them understood the deal. Only when one of them managed to pull an experienced investor in that sector into the group, only then did she manage to get somewhere with one of these groups. And then everyone jumped in on the deal, and she was almost oversubscribed in the end because someone actually understood what she was trying to achieve. Just because you apply to these groups and you don't get accepted, then it doesn't mean that it's not any good. It just means it's not the right investor for you. And if they give you good feedback, then it's good to readjust what you're doing if it makes sense. But these small, more friendly kind of angel groups, not angel groups, kind of sometimes angels group together, or investment groups are often the best way to go when it comes to venture capital. And in the next section, I'm going to be talking about how to find investors through equity crowdfunding. So in the previous two sections, we talked about how to find the right investors, and then angel investors, how to find the right venture capital firms. Now we're going to talk about how to crowdfund for equity as an investment vehicle. So what I'm going to be going through is a little bit of a step-by-step, but before we do that, let me just explain what equity crowdfunding is about. So it is not a reward site, it's not Kickstarter, it's not Indiegogo, so you're not selling products or services through it. You're selling pure shares to the general public. What the beauty of equity crowdfunding platforms is it gives you a legal platform to be able to do this, whereas before it was totally illegal and impossible to do this. So that's the best way to look at it, as a safe house for securing investment from the general public or from your customers or from family and friends, to put them all in one place. The two main platforms I'll give you are Crowdcube. Crowdcube has hundreds of thousands of investors on that platform. It's been probably the oldest platform there is. And then there's Seedrs. And Seedrs has slightly less registered investors, but it's still a very valid platform. So in the UK, these are the two main platforms. The differences between them generally are that one has a very strong nominee structure, that's Seedrs. That means they own all the shares, not own all the shares, but they act as a nominee for all the shares from all the investors that on that particular site for your campaign. Whereas Crowdcube, they're your shareholders basically. It's up to you to maintain the shareholders or those investors, or have investor relations once the campaign's been closed. Whereas Seedrs, they will act as a single point of contact for all the investors. Now they're both good platforms. And they've both got similar kind of structures and approaches. So I'm just going to go through a blow by blow of how to actually put a campaign together. So number one, the very first thing you want to do is basically get the pitch docs together. So you want to actually get the exec summary, which I've gone through on a different course, and you want to get the pitch deck, which I've gone on a different course, and the financial templates, which I've also gone through. And then we also need to get a video together. The video needs to be 3.5 minutes long, and has got a particular format behind it, or a recipe behind it. If you go onto Seedrs or Crowdcube, then you can see how a lot of the videos are done. Also, I offer a kind of downloadable kind of format, general guideline as to what to expect when you're putting this video together, what kind of components need to be in place. Okay, so let me give you a step-by-step of how to break this crowdfunding campaign down. So the very first thing you need to do is get the documents together. So you want the exec summary, you want the actual pitch deck, you want the financial forecast, and then you want the crowdfunding video. And then once you've got all those together, then it all comes down to marketing. And firstly, sense check the proposition is actually right for equity crowdfunding. And that is, the idea is not only scalable, it's easy to get. So even your Aunt Agatha could understand it and get it. And also the management team is fairly credible. It doesn't have to be a complete team, but a team, when you've got investment, at least mainly has to be in place. And also it does help if you've already got some customers or some kind of traction, that you can then help them see that there's a reduction in risk there. Not only that, but you can use a lot of your customers and contacts to actually then form part of the campaign. So once you think, well, I'm going to go for it, I think I've got something that's suitable for the equity crowdfunding, and you've got all the documents in place, then decide which platform is suitable for you. remember you've got Crowdcube and you've got Seedrs. Seedrs is a nominee structure. Crowdcube is they do nominee structure, but it's mainly non-nominee structure. And then speak to both of them, find out which ones are suitable for you. In general, and this could change, Crowdcube is generally quite good at a community-based project. So if you've got a retail project, for example, and you're selling product, or you've got, for example, you've got a new type of beer, or you've got a new type of service, and it's consumer-led, it's B2C, then Crowdcube could be the way to go. Where if it's more B2B, slightly more sophisticated, then Seedrs might be the best platform for you. But best to speak to both of them and come to an understanding of where each one sit. The fee structures are generally similar, but can be a little bit different. So generally there's no upfront cost involved in it, apart from what it costs to make the video perhaps. But then they base it on a success fee, which could be anywhere from 6%, maybe right up to 8%. Then they might charge you a fee for actually getting the documents sorted at the end of the campaign, but only if it's a successful campaign. And then there might be some fee for transaction charges, which is typically around about 0.5%. Now these structures might change as they do evolve and change over time. So it is good to speak to them beforehand. But once you've got a clear idea of which platform to go for, then you might want to think about then start engaging your own community and customers by sending out a very short kind of survey. So if you put out the survey, then it gives you a chance to actually flush out who maybe perhaps be the bigger investors that will put in somewhere between £5,000 or £10,000. And then maybe also a bunch of smaller ones, but it's really useful tool to try and get an understanding how much kind of interest and commitment that you might have for the future. Because ultimately what we're trying to do if going for crowdfunding campaigns is a very key number that is worth remembering, and that is 40%. You're looking to get 40% of whatever target that you are going for committed before the public gets a chance to look at your campaign. So in essence, there are 3 types of launches that we do. We do the survey launch, which we've just talked about, where you just put out a 1-minute survey to get an idea of how much they'll be interested in investing, even if it's as little as £10, up to £10,000 plus. That should flush out the active investors or the people that are really keen on your project. And then you've got another launch. So when you're then cultivating this interest in a series of emails, communications with them, and then trying to galvanize them to go on your equity platform of choice, and then create a private launch so that the general public cannot see your launch, but it's still on the same platform. For example, if you were to go on Crowdcube, then you would have a private link where you would then give this private link to everyone that said, yes, I'd like to put in something. And then they get a chance to actually show their commitment by making the investment onto that platform. But then only when it triggers 40% does it become live to the general public. Now, the reason is for that, because basically if you get to 40%, it's like a psychological trigger that if you get to 40% on launch, I would estimate there's an 80% chance of success that the campaign is going to work, because then you're on the upswing from the very first day, and that means you get more people following your campaign, more questions, more people requesting business plan, and the platform itself like it, and you'll go to the page more often. Right to the top of the page, which means you have a virtuous cycle where you get more and more views and more requests for business plans and more investments. Whereas if you start too low, like 20% or under, then is a good chance you'll be completely buried on the site, and it won't really have any tipping point whatsoever. So it's really important to when you're going to launch a tool, please don't waste your time launching on much less. I would say at the very least it's probably 30%, but much less than 30%. But ideally 40%, then you're in with a good chance. Then on crowdfunding, then it comes down to some key activities. And those are doing regular updates on your campaign page, so that I would recommend twice a week, spaced out over the week. One update might be of some kind of business news, how you're on the increase, how sales have increased, how you got a new product line, and maybe a new team member, and maybe might be some PR that you've got, or just the fact that you're always thrilled that you're at 50% already. Those are the updates, and then you've got the forum, which is probably more crucial even than the updates. And on the forum, all the investors get a chance to ask you questions on that. So you want to make sure that this is as active as possible, and you encourage your community to ask questions on the forum. If they've got a question, say, could you ask it on the forum? Because then everyone else gets a chance to see how you respond and what your brilliant response is. And then any objections that people have got for not investing sometimes get removed because you've answered the question that's been a blocker for them on the forum. So so between the forum and between then the updates, and then maybe offline activities like launch parties and maybe meet and greet events and maybe webinars and other things that you could do to generate traffic and traction for your campaign, you just try and keep the momentum. Momentum is absolutely key on crowdfunding campaigns. Most campaigns have about a 30-day period. Some have a 60-day period. Seeders are 60 days, Crowdcube's 30 days. But ultimately you want to finish as fast as possible. Ideally, you want to finish well before 30 days if you can. Just keep the momentum, keep pressing all the way down the line. When you hit your target, then ultimately you want to overfund. So you want to overfund all the campaigns that I've worked on, and I've worked on at this point in time nearly 20 campaigns. My average overfund is about 150%. So name of the game in crowdfunding is overfunding. Not just hitting a target. So whatever target you set, make sure it is a low target. It's the least target you think you can get away with as a viable business for the next development path. And then everything else just helps you grow even faster. So try and hit your target as fast as possible, and then you've got time to develop and grow into a really good overfunding situation. So that's it on crowdfunding. And in a nutshell, I'm just going to wrap everything up in the next section. Now in this section, I'm just going to wrap everything up that we talked about how to find the right investors. Now firstly, we talked about angel investors, and we talked about the importance of going to angel groups, curating your own list, actually learning how to match the right investors with yourself, not just any old investors. So you actually have to actively research them, find that it's a good fit investor for you. And we learned how to actually approach them using maybe LinkedIn, and then how to actually have a dialogue with them through face-to-face. And then we've talked about how to actually close the angel investors. Now, we also talked about the venture capital firms. We talked that there's two types. There's the big VC firms and there's the small ones. The big VC firms are there more for disruptive big businesses, big funding opportunities. And if possible, I would try and avoid that situation. But if it is a case that you go big VCs, please get more than one big VC in the negotiating room with you, or not in the same room, in the same negotiating table, virtually speaking. And also make sure you've got extremely good investment lawyer with you. And with the small funds, they're much more easier to get on with. They're much more nurturing. They want to actually often have a seat on the board, and they want to help grow that company. They're for small amounts of money, starts at 50,000, goes up to about $1 million. Download the list that I mentioned and have a look at the curated list of these investor groups, so you can then shortlist maybe 3 or 4 of them to start approaching. And then finally, we talked about equity crowdfunding and that there are Seeders and Crowdcube, and make sure you select the right platform for you. Test your own community, see what kind of commitment you've got, and get all the documents into place, the exec summary, the pitch deck, and the financials. And then you could go and then start launching a campaign. But please do remember the 40% rule. Do not launch and go public, ideally, until you've got to 40%. Now, putting all of these together, I've treated them as separate ways to get investment, but actually they all work together. Most of the deals that I've kind of consulted on these days has been a mix of all three. So, for example, they might have gone out and got a few angels. They might have 3 or 4 angel investors that might have together, between them, put together, say, £100,000 into an opportunity. Then they've gone to a small fund that are quite happy to put, say, another £50,000 to £100,000 into that opportunity, into that round. And then using these two, you can maybe tip to 40% or even 50%. And then, for example, you put these two together and you might be maybe closer to, say, £150,000 between angel investors and between the small funds. And then if you put that on a crowdfunding campaign, and then you instantly, not even touching any community, you're at 50% funded, then you stand a very good chance of attracting the rest of the round through an equity funding campaign. So it's not just set pieces, you can use all three together. So take the time to think about which is the right investor for you. Maybe it's a mixture of all three, or maybe not. But then start taking action and moving towards at least one of these. The next part of it is the problem. So now we've defined the big idea and the USP, it's time to move on to what is the pain point now in your concept. Why should people actually go out and buy it? And what would have to happen in their lives for them to go out?